Imagine, just for a second, one person making a single financial decision. Not just one that ripples through markets, but one that ends up costing a national government billions, billions of dollars,
Right.
and forces them to completely change their core economic policy.
Yeah, it sounds like something out of a Hollywood movie, doesn't it? A financial thriller plot.
Exactly. But this isn't fiction. It's the real story of George Soros and his, well, now it's legendary, trade against the British pound way back in 1992.
A single massive bet. We're talking $10 billion.
$10 billion. And it culminated in a day that's literally got its own name etched in financial history books, Black Wednesday.
A day that shook the financial world.
Welcome to the Deep Dive. This is where we take the sources you send us, articles, research, notes, you name it, and we don't just skim them, we really dig in.
Yeah, we pull out the key insights, the core knowledge, connect the dots for you.
Our aim is to give you a shortcut, really, to getting your head around complex stuff. And today, wow, we are diving deep into the material you shared about one of the most dramatic, maybe pivotal moments in modern financial history.
That showdown, Soros versus the Bank of England.
Exactly. So, our mission for this deep dive is pretty clear. We want to extract the absolute core insights from all this material you provided.
We're not just looking at what happened on Black Wednesday, though. We'll cover that.
No, we want to unpack Soros' strategy, get into his thinking, which is fascinating, sometimes controversial, understand what was going through his mind when he made that audacious move.
And really relive those dramatic hours of Black Wednesday itself.
Minute by minute, almost. And then look at the fallout, the lasting impact of this single huge trade. For Soros, obviously, but also for the UK and really the wider world.
So we're giving you the essential breakdown of this whole event and some lessons that resonate even today.
Okay, let's get into it. Let's unpack this.
So to really understand the whole thing, you've got to look at the setup, the context leading into 92. The sources really emphasize this.
Right, the background situation.
Britain, at the time, was a member of something called the European Exchange Rate Mechanism, the ERM.
Okay, the ERM. What was that all about?
Well, basically, it was set up to try and stabilize exchange rates between European countries, sort of a stepping stone towards eventually a single European currency.
Ah, okay. So stability was the goal.
Exactly. And the key rule, for this story anyway, was that member currencies, like the British pound, had to stay within a really narrow band, a tight range, against the strongest currency in the system.
Which was the German Deutschmark, right?
The Deutschmark, precisely. The powerhouse currency at the time. So the pound was effectively pegged or tied to the mark.
Okay, so far so stable in theory. But if you actually look under the hood to the UK economy back then, the sources paint a different picture, don't they?
Oh, absolutely. The picture was, let's say, less rosy. You had pretty high inflation chewing away at people's spending power. You had ongoing struggles with low productivity, meaning British industry wasn't as competitive as it could be.
Right.
And on top of that, there was this growing pile of public debt weighing things down. These weren't just small hiccups. There were pretty fundamental weaknesses in the economy.
So you've got this fundamental mismatch brewing. On one side, the UK government is committed to this ERM thing, promising to keep the pound strong against the Deutschmark.
Yeah, keeping it fixed within that narrow band at a relatively high value.
But on the other side, you've got the actual reality of their economy screaming that the pound should probably be weaker. High inflation, low productivity. It just didn't add up.
Exactly. It was a classic case of the currency being, well, fundamentally overvalued based on its real economic health. The ERM commitment was forcing it to stay high, artificially high.
Which puts the Bank of England in a really tough spot. I mean, an almost impossible position, you could argue.
Totally. They were obligated by the ERM rules to stop the pound from falling below its agreed floor level in that band. They had to defend it.
So how did they try to do that? The sources mention the tools they used, right? Trying to prop up the pound against these strong economic headwinds.
Yeah, they basically threw two main tools at the problem, and both became increasingly painful as the pressure mounted.
Okay, what was the first one?
Interest rates. They hiked interest rates dramatically.
Ah, The theory being high rates attract foreign money.
Precisely. Make it more attractive for international investors to park their money in pounds, seeking those higher returns. More demand for pounds should, theoretically, push the value up.
But the cost?
Oh, the cost domestically was severe. High interest rates choke off borrowing for businesses wanting to invest, for consumers wanting to buy homes or cars. It slows down the whole economy, costs jobs.
So they're basically hitting the brakes hard on an already struggling economy, just to keep the currency value up for the ERM.
Yeah, politically, it was becoming incredibly unpopular, sacrificing the real economy, jobs and growth, on the altar of this ERM commitment.
Okay, that's one tool. What was the other way they tried to defend the pound? Direct intervention.
Exactly. Direct intervention in the currency markets. The Bank of England started spending its foreign currency reserves.
So using their savings of other currencies?
Yep. They'd use things like US dollars, Japanese yen, and crucially, German Deutschmarks from their reserves to buy up huge amounts of British pounds on the open market.
Trying to create artificial demand for the pound?
Just to support the price, yeah. Think of it like a company buying its own shares to stop the price from falling, but there's a limit, right?
Right, those reserves aren't bottomless.
Exactly. The more billions they spent buying pounds, the weaker their own financial position became. And it started to look more and more like a desperate, costly, and maybe unwinnable fight against the fundamental market forces that were pushing the pound down.
And this whole setup, the overvalued pound, the struggling economy, the Bank of England burning through reserves and hiking rates, this is the situation that George Soros is looking at. And the sources really stress he wasn't just reading the headlines. He saw this fundamental contradiction, this mismatch.
He did. He saw it not just as a problem, but as a massive opportunity. He famously described it as a pressure cooker situation. Something had to give.
He fundamentally believed the pound was way too high because of this artificial ERM peg.
Yeah, he viewed the Bank of England's efforts, the high rate spending reserves, as just, ultimately futile attempts to defy economic gravity.
He saw a deeper flaw.
Structural weakness, yeah. A major economy trying to lock its currency to a stronger one, using rules that just ignored its own internal economic reality. He wasn't just predicting a dip. He saw a systemic vulnerability that was bound to break under pressure.
So for Soros, this went beyond just a technical trade. It was about questioning the accepted wisdom, right? Even challenging the government's entire policy.
Absolutely. The sources paint him as someone who didn't just play within the market rules. He actively challenged authority, including governments, when he believed their understanding or actions were flawed.
And this seems rooted in his core belief about how markets work, or rather, how most people think they work versus how they actually work.
Exactly. A central part of his philosophy, according to the material we looked at, is that most people, and that includes big institutions, even governments, they fundamentally misunderstand the nature of financial markets.
They see them as rational, efficient.
Yeah, the common view is that markets are like these perfect scales, just weighing the economic facts and reflecting the underlying reality in prices. Soros thought that was, profoundly wrong.
Which brings us to his big idea, reflexivity.
Yeah.
This is key to his thinking, but it can sound a bit philosophical.
It is a bit abstract, but it's absolutely crucial to understanding his mindset and this trade. Reflexivity, in Soros's view, means markets aren't just passive mirrors. They don't just reflect reality.
Okay, so what do?
They actively participate in shaping it. They can distort the very reality they're supposed to be reflecting. There's this constant feedback loop.
A feedback loop. How did that apply to the pound?
Okay, think about it. The market perceived the pound as stable, maybe even strong, because it was officially locked into the ERM. That perception was based on the rule, the system.
Right. The official policy said it was stable.
But the reality, as we discussed, was the weak UK economy, high inflation, low productivity. That reality suggested the pound shouldn't be that strong.
So perception versus reality.
Exactly. Soros saw the market's perception, stability because of the ERM, was built on an illusion that flew in the face of the underlying economic facts' weakness.
Okay.
And here's the reflexive part. He believed that if enough people in the market recognized this gap and started acting on the reality, i.e. selling the pound because the economy was weak, their actions could actually force the price down.
So the selling itself changes the situation.
Precisely. Enough selling pressure could break the ERM peg, shatter that initial illusion of stability, and create a new reality, a much weaker pound. Perception influences reality, which then changes perception again. It's a loop.
Wow. So his trade wasn't just a bet that the pound would fall. It was almost an act designed to help make it fall by exposing that fundamental weakness, leveraging that reflexive loop.
That's a really good way to put it. He had the logic the UK economy was struggling. He had the data. And he had this deep conviction, based on his reflexivity theory, that the Bank of England's defense just couldn't hold against overwhelming market pressure if that pressure was focused on the underlying truth.
So it wasn't just a gamble in his eyes. It was more like systematically exploiting a flaw in the system's self-perception.
Exactly. He was attacking what he saw as a vulnerable point, a kind of collective self-deception propped up by policy.
It really underscores how he viewed markets, not just as money-making venues, but as, like, laboratories for testing his ideas about how the world works.
And Black Wednesday became the ultimate high-stakes test case for reflexivity, played out on a global stage. It showed that collective market belief, even if initially flawed, could become this incredibly powerful force that even strong governments might not be able to withstand.
Okay, so he's got the theory. He's identified the weak spot, the overvalued pound in the ERM. But having an idea is one thing. Acting on it is another. He needed a concrete plan.
And he definitely had one, executed through his famous hedge fund, the Quantum Fund.
The target was clear. That unsustainable pound peg.
Yep, a currency propped up more by political promises than by actual economic strength. Very vulnerable in his view.
And the weapon of choice was building this absolutely enormous short position against the pound. Let's just quickly recap what shorting means here for anyone not familiar.
Sure, in simple terms, shorting a currency like the pound involves borrowing a huge amount of it. So Soros's fund borrows billions of pounds.
Okay, borrows pound.
Then they immediately sell those borrowed pounds on the foreign exchange market, usually swapping them for a stronger currency like Deutschmarks or US dollars.
Right, sell high.
Sell high, exactly. But you do this with the expectation, the strong belief that the pound's value is going to fall significantly. Then, once the pound has fallen, you buy back the same amount of pounds you originally borrowed, but now at a much lower price.
Ah, buy low.
Buy low. You return the pounds to whoever you borrowed them from, and the difference between the high price you sold them at and the low price you bought them back at, that's your profit.
So basically, you profit massively if the currency crashes. The further it falls, the more you make.
That's the mechanics of it. And the sources really hammer home the sheer, almost unbelievable scale of Soros's bet here.
This wasn't some small speculative punt.
Not even close. The Quantum Fund, under his direction, spent weeks, maybe months, quietly but very aggressively building the short position.
How big are we talking?
By early September 1992, just before things really kicked off, the sources suggest the Quantum Fund held a short position against the pound worth around, wait for it,
$10 billion.
$1 billion in 1992 money.
Yep. That's a staggering amount, even today. Back then, for a single hedge fund to leverage up and make a bet that big against a major world currency like the pound, it was almost unheard of. Required incredible nerve and deep pockets, obviously.
Absolutely. But here's where it gets even more strategic. Just building the position wasn't the whole game. Soros then made a really critical move.
Which was?
He went public. He didn't keep his massive bet a secret. He, or sources close to him, let it be known that he believed the pound was fundamentally overvalued and that it was going to fall.
Wait, why do that? Wouldn't you want to keep a $10 billion bet under wraps? Seems counterintuitive.
You'd think so, right? But according to the analysis and the sources, this was a calculated masterstroke. Going public wasn't just him sharing his opinion. It was a powerful signal to the entire market.
How so?
Well, Soros was already this hugely respected, maybe even feared figure in global finance. People watched him. When word got out that he had built such an enormous position and was publicly stating his conviction that the pound was doomed,
Other traders would pay attention.
they absolutely did. It acted like a giant flare going up. It signaled his immense confidence based on his deep analysis, not just a whim. And it essentially validated the fears that many others might have already had, but were perhaps afraid to act on so aggressively.
So it triggered a herd mentality, reflexivity in action again.
Exactly. His public stance, backed by that $10 billion statement, caused a ripple effect, maybe even panic. Other hedge funds, speculators, traders all around the world saw Soros's move and thought, he sees it, he's committed, the pound is vulnerable.
So they jumped on the bandwagon.
They piled in. They started shorting the pound too, wanting to ride the wave that Soros had started. This massively amplified the selling pressure on the pound, far beyond just Soros's initial $10 billion.
So his bet became a catalyst.
A catalyst that galvanized a much bigger market force, all pushing in the same direction down for the pound. He wasn't just betting on the fall, he was actively helping to orchestrate it by signaling his move.
Which brings us right to the climax. Black Wednesday, September 16th, 1992. The day the dam finally broke.
It was, by all accounts and the sources, a day of absolute chaos and frantic activity in London, particularly at the Treasury and the Bank of England.
They're facing this tidal wave of selling pressure now, right?
Yeah.
Soros, plus everyone who followed him, billions and billions of pounds being dumped.
An overwhelming force.
Yeah.
And the British government and the Bank of England launched this desperate last-ditch defense to try and save the pound's peg in the ERM.
Using those same two tools we talked about earlier, but pushed to the absolute extreme.
To the limit, yeah. First, interest rates. The sources describe this almost hour-by-hour battle. They started the day with rates already high at 10%.
Which was already hurting the economy.
Right. But as the selling intensified, they announced a hike to 12%. Just threw it out there.
Did it work?
Nope. The selling continued, maybe even accelerated. So later that same day, in a move that shocked almost everyone, they announced another hike, all the way up to 15%.
15%. So imagine the panic behind that decision, trying to bribe people to hold pounds with the rates that would absolutely crush domestic borrowers.
Utter desperation. And at the same time, they were hemorrhaging their foreign reserve.
Buying pounds like crazy on the open market.
Billions and billions. The sources mention estimates of tens of billions of pounds worth of reserves being spent in just a matter of hours, trying to soak up all the selling, constantly intervening.
But it wasn't enough. The market tide was just too strong.
Too strong. The combined weight of Soros's massive position, amplified by the global herd he helped unleash, simply overwhelmed the Bank of England's ability to defend the currency. They couldn't buy pounds fast enough.
A losing battle.
Completely. Despite the extreme rate hikes, despite burning through a huge chunk of the nation's reserves, the defense crumbled. The market's conviction, fueled by Soros, was just too powerful.
So what happened at the end of the day?
By late afternoon, early evening on September 16th, the UK government had to face reality. They threw in the towel. They announced that the UK was suspending its membership in the European exchange rate mechanism, pulling out.
Wow. And the immediate result for the pound?
It plunged instantly. It had been held up artificially by the ERM commitment and all that desperate buying. As soon as that support was removed, bang. Its value dropped like a stone against the Deutschmark, against the dollar, against everything. It found its more natural level, reflecting the weaker economy.
And for George Soros and the Quantum Fund, the payoff.
Huge. Once the pound crashed, he closed his short position. Remember, that means buying back the pounds he'd borrowed and sold earlier.
But now buying them back much, much cheaper.
Exactly. The difference between the high price he sold at and the very low price he bought back at was pure profit. The sources consistently estimate the Quantum Fund cleared over $1 billion in profit.
$1 billion in basically 24 hours.
Mind-boggling profit from a single trade event.
And the cost on the other side, for the UK government, the taxpayers.
The estimates cited in the sources put the loss to the British Treasury from its failed defense at over £3.3 billion, a massive hit to public funds and a huge political embarrassment.
So Black Wednesday wasn't just about Soros making a fortune. It was this landmark event, wasn't it? It changed things.
Fundamentally, it proved quite dramatically that a single determined private investor, if they had enough capital, the right analysis, and understood the system's weaknesses, could actually go head-to-head with a major central bank and win.
Could force a sovereign nation to abandon its central economic policy.
Precisely. It exposed the potential fragility of fixed exchange rate systems when the underlying economics don't line up. And it starkly demonstrated the raw power that coordinated market forces could wield, especially when catalyzed by a figure like Soros. It really shifted the perception of power between markets and governments.
So let's dig into Soros himself a bit more. What gave him the edge? It wasn't just luck, clearly. What was it about his mindset, his habits, his approach? According to the sources.
Yeah, the sources definitely try to unpack what made him different, what gave him that edge. It wasn't just about having access to special information, though I'm sure he was well informed.
It was more about how he thought.
Exactly, how he processed information, and crucially, how quickly and decisively he acted on his insights.
Critical thinking seems absolutely central. His willingness to question everything.
Totally. The sources describe him as having this deep-seated skepticism towards market consensus, towards what everyone believed. He actively looked for contradictions, for places where the story the market was telling itself didn't match the underlying facts.
That famous quote attributed to him comes to mind. I'm only rich because I know when I'm wrong.
That's so telling, isn't it? It suggests his strength wasn't necessarily always being right, but being incredibly attuned to the possibility of being wrong, both in his own thinking and in the market's collective view. He could admit mistakes, cut losses, adapt instantly. He seemed immune to that comfortable feeling of just going along with the crowd.
While everyone else felt safe because the pound was in the ERM.
He looked at the shaky economic foundations and saw the danger, the illusion. He wasn't swayed by the consensus narrative.
And he coupled that thinking with a willingness to use serious leverage, right? The $10 billion wasn't all his own money.
Not at all. The sources are clear. He used significant borrowed capital leverage to build that position to such a massive scale. This is a really key differentiator.
Because most investors try to diversify, spread the risk.
Right. Soros was different. When he had extremely high conviction in an idea, based on that deep contrarian analysis, he was willing to concentrate enormous amounts of capital, including borrowed funds, onto that single idea. He went for the jugular, essentially.
Sounds incredibly risky, though. Betting the farm almost on being right.
Well, yes and no. It looks incredibly risky from the outside, but the sources frame it as highly strategic risk-taking based on his concept of asymmetric risk.
Asymmetric risk, meaning the potential reward versus the potential loss.
Exactly. In the pound trade, he calculated that the potential upside if he was right and the pound collapsed was absolutely enormous, billions in profit. The potential downside if he was wrong, the Bank of England held the line, and he had to cover his short at a small loss or break even, was still significant in dollar terms, but it was contained relative to that gigantic potential gain.
So the reward vastly outweighed the risk in his calculation.
He believed so. He wasn't just gambling recklessly, he was mastering the art of deploying huge capital where the perceived payoff was disproportionately large compared to the potential loss, even if success wasn't 100% guaranteed. He wasn't avoiding risk, he was strategically embracing it where the odds looked heavily skewed in his favor.
And timing. We keep coming back to timing. The sources really stress this.
Crucial, possibly the most crucial element after spotting the opportunity itself. He didn't wait until the crisis was obvious, until everyone was scrambling.
He moved early.
He moved early. He started building that massive short position quietly before the pressure cooker truly exploded. While others were still debating if the ERM peg was really sustainable, he was already positioning himself for the inevitable breakdown, as he saw it.
And then that public announcement we talked about, that was timed perfectly to ignite the situation.
Perfectly. It landed right when market tensions were already high. It acted as that catalyst, that signal that pushed things over the edge, triggering the cascade of selling that finally overwhelmed the Bank of England.
It really supports that other quote attributed to him, doesn't it? The greatest edge in investing isn't information, it's timing.
Absolutely nails it. Having the right analysis is necessary, but acting decisively, and often before the crowd, at the right moment, that's where the real edge often lies, according to his approach.
It feels like his success wasn't just about financial acumen alone. The sources suggest it was deeply connected to his broader philosophy, his beliefs about the world. Making money wasn't the ultimate endgame for him.
That's a really significant theme in the material. It distinguishes him. The sources often cite him saying something like, making money as a byproduct. The real goal is to prove I'm right.
Using the market as a testing ground for ideas.
Exactly. The financial markets weren't just a casino for him. They were an arena where he could test his intellectual framework, his theories about how systems, especially flawed systems, operate, and particularly his core theory of reflexivity. The profit from Black Wednesday wasn't just money. It was powerful validation that his analysis of the pound's unsustainable situation was correct.
That's a really different way of looking at finance. And part of that philosophy seems to be about embracing uncertainty.
Very much so. The sources point out that unlike many people, especially in finance, who crave certainty and rely on neat predictive models, Soros seemed to accept, even embrace, the idea that the world, and especially complex systems like markets and societies, are fundamentally unstable, unpredictable, and full of potential errors and misjudgments. That's reflexivity again.
So he didn't trust rigid forecasts.
No, he relied more on adaptive thinking. Constant questioning, being open to new information, being ready to admit he was wrong and change course. It was more about navigating the inherent messiness and chaos of reality rather than pretending you could perfectly predict or control it.
And famously, after making these billions, particularly from Black Wednesday, he didn't just, buy a bigger yacht and retire. He channeled that wealth into something much bigger.
Yeah, that's probably the defining chapter of his life after the huge financial successes. He dedicated himself and his fortune to promoting what he calls open societies.
Through the Open Society Foundation's OSF.
Exactly. He established OSF and poured billions into it. It became the main vehicle for his mission beyond finance.
And the scale of that philanthropy is just staggering when you look at the numbers.
It really is. The sources mention he's donated over $32 billion through OSF over his lifetime. $32 billion. That's estimated to be more than 64% of his entire personal fortune. It's an extraordinary level of philanthropic commitment.
And what does OSF actually do with all that money?
It operates globally, across more than 100 countries, funding a huge range of initiatives. Things like promoting education, defending human rights, supporting independent journalism and media freedom, backing democratic movements, advocating for social justice. A very broad mandate aimed at fostering open democratic societies.
So the wealth generated from these incredibly shrewd, sometimes controversial financial trades like Black Wednesday became the fuel for this massive global influence engine.
That's exactly how the sources frame it. He seemed to view his financial activities and his philanthropy as interconnected. He used trades sometimes to send messages or highlight flaws, and then used the resulting wealth to actively fund causes and intervene in ways he believed would shape real-world outcomes, aligning with his vision of an open society.
It's a view of capital having a narrative, a political force almost.
Definitely. Playing a long game, focused on impact, even if it meant stirring up controversy, which it certainly did. He wasn't trying to be popular, he was trying to make a difference on his terms.
And controversial is definitely the word. That Black Wednesday trade, combined with the sheer scale and reach of his OSF funding, really cemented his image as something far more than just a hedge fund guy.
Oh, absolutely. He became this global symbol, a figure of immense, almost mythical financial power who could take on governments. To some, he's this philanthropic genius, using his wealth for good, exposing flaws.
But to others.
To others, he's seen as a dangerous, meddling force, using his billions to interfere in the internal affairs of sovereign nations, pushing a specific political agenda. He's a deeply polarizing figure.
But he undeniably proved that an individual could take on a central bank and force its hand. That perception shift was huge.
Before 1992, the idea seemed almost outlandish, right? That one private speculator could muster enough firepower to break a major country's monetary policy. Black Wednesday shattered that notion.
It showed the vulnerability.
It showed that when the economic fundamentals were truly out of whack with policy promises, market forces, especially when led by someone with Soros's insight, capital, and nerve, could indeed overwhelm governmental defenses. That's why he got stuck with that nickname. The man who broke the Bank of England. It captured that unprecedented demonstration of market power over state power.
And it changed how people viewed markets, not just as investment platforms, but as potential battlegrounds.
Exactly, where huge financial players could actively challenge and influence national policy.
And then beyond finance, that influence continued and expanded through the Open Society Foundation's work worldwide.
Yeah, the sources really highlight the impact OSF funding has had over decades. Supporting democratic transitions after the fall of the Soviet Union in Eastern Europe, funding independent media outlets and civil society groups that are pushing back against authoritarian trends today in places like Hungary or Russia, advocating for human rights globally. His philanthropic reach gave him this unique non-governmental form of global influence.
But that very influence and the specific causes OSF champions, often challenging incumbent powers, is exactly why he attracts so much fire, so much criticism.
Without a doubt. The sources acknowledge this huge controversy. He's constantly accused by various governments, particularly more authoritarian ones, or those whose policies OSF criticizes, of interfering, of destabilization, of using his money to push a foreign agenda.
He's become a major target, almost a bogeyman figure for some groups.
Especially on the political right globally. He's often portrayed in certain media circles as this shadowy puppet master pulling strings behind the scenes. That narrative is a huge part of his public image, alongside the admiration he receives from others.
Yet, despite all that intense criticism and the bogeyman image, His work and influence are also recognized at the very highest levels, aren't they?
Yes, that's an important counterpoint the sources bring up. There was a very high-profile recognition recently. In May 2025, the sources note George Soros was awarded the Presidential Medal of Freedom by the U.S. president.
America's highest civilian honor.
Exactly. And the citation wasn't just about his finance career. It specifically highlighted his decades of philanthropic work and his commitment to promoting democracy and open societies around the world. So that's a powerful statement from one perspective, acknowledging his impact as a positive contribution.
It just highlights the complexity of his legacy. Genius trader, controversial figure, massive philanthropist, political target,
Yeah.
all wrapped up in one person.
The truly unique and impactful figure on the world stage for decades.
Okay, so let's try and pull this all together. Looking back at this whole incredible saga, Soros, the pound, Black Wednesday, what are the big, timeless takeaways, the key lessons we can distill from the source material about this event and his approach?
Well, it really is a classic case study, isn't it? You've got the core event, September 16th, 1992. Soros is $10 billion short, forces the UK out of the ERM. He makes $1 billion, the UK loses over $3 billion. Drama.
But beyond the headline numbers, the sources offer some really profound insights. You mentioned 5 timeless lessons.
Yeah, 5 key themes that seem to emerge consistently from analyzing Soros and this trade. The first one is fundamental. Markets are not rational.
Back to reflexivity.
Exactly. Lesson 1. Markets operate on beliefs, perceptions, sometimes collective illusions. The biggest opportunities often come not just from crunching numbers, but from spotting where the market's belief clashes with the underlying reality. Challenging that flawed consensus, like Soros did with the stable pound, is where the real edge can be found.
Okay, lesson 1. Challenge market illusions. What's lesson 2?
Lesson 2. Timing is often more important than just having the information.
Acting decisively at the right moment.
Precisely. Soros didn't just know the pound was vulnerable. He acted before the crisis fully erupted. He built his position, then timed his public signal perfectly to amplify the pressure. Knowing something is one thing. Acting strategically when the moment is right gives you a massive advantage.
Got it. Lesson 3. Something about leverage.
Lesson 3. Strategic use of leverage on high-conviction, asymmetric bets can generate huge returns.
Keywords there.
Yeah.
Strategic, high conviction, asymmetric.
Right. It's not about reckless leverage on everything. It's about identifying those rare opportunities where you have strong reason to believe the potential upside dwarfs the potential downside. And then having the courage to deploy significant capital, maybe including borrowed funds, to maximize the impact if you're right. It's about mastering risk, not just avoiding it.
Makes sense. Lesson 4. This one feels tied to his philanthropy.
Lesson 4. Profit can be a powerful tool for broader influence and impact beyond just personal wealth.
Using money as a means, not just an end.
Exactly. Soros's career post-Black Wednesday, dedicating billions through OSF, shows this clearly. Financial success can be converted into significant power to pursue larger missions, whether it's promoting open societies or other goals. Money becomes fuel for influence.
And the final one, lesson 5,
Right.
about individual impact.
Lesson 5. An individual thinking differently and acting decisively can significantly impact global forces.
You don't need to be a state to shake things up.
Soros proved that. By applying that critical thinking, having deep conviction, understanding how complex systems like markets and governments really work, or don't work, and having the capital and strategy to act, one person could challenge established powers and genuinely reshape events. It's a powerful statement about individual agency.
5 really potent lessons there. It definitely leaves you thinking differently about markets, power, strategy.
It's a story that resonates on so many levels long after the event itself.
So let's leave our listeners with a final thought to chew on, based on everything we've unpacked from the sources today.
Okay.
Considering the whole picture,
Yeah.
the huge financial loss for the UK, the billion-dollar profit for Soros, and then seeing how he used so much of that wealth and subsequent wealth to fund the Open Society Foundations and try to influence global affairs, how do you view someone like Soros?
Yeah, it's the core dilemma, isn't it?
Is he primarily an opportunist? Someone who brilliantly spots and exploits weaknesses in the system for massive personal gain, regardless of the collateral damage? Or is he more complex? Maybe an agent who, yes, is disruptive and profits immensely, but in doing so also helps expose and ultimately correct flawed systems, and then uses the proceeds for broader, perhaps even beneficial, societal aims.
Opportunist versus flawed system corrector. Or maybe elements of both.
Exactly. There's no easy answer, and the sources present evidence you could use to argue either way. But it's a fascinating question about the role and impact of such powerful individuals in our global system, something to definitely mull over.
A great question to end on.
Well, thank you for joining us on this really deep dive into George Soros, Black Wednesday, and everything surrounding it. It's a complex, controversial, but undeniably important story.
So much to unpack about strategy, psychology, market dynamics, global influence.
We really hope this discussion, drawing on all the material you provided, has given you a much clearer, more nuanced understanding of this pivotal moment in financial history and the lasting lessons it might hold.
It really is a powerful case study of the interplay between markets, governments, and individual actors.
We look forward to our next deep dive, where we'll take another set of your sources and dig into another fascinating topic, pulling out those key insights to help you stay informed. Until then.